Hello to everyone. Today I am here with the introduction to the Managerial Finance Part 5. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover the role of financial market, the dual function of financial market, the equity market. Are equity market efficient processor of information, the profitability check. The role of the financial market play a key role in the process of business growth and value creation by performing two fundamental functions that include the primary and the secondary market functions. Primary market provide the financing required to fund new business ventures and to grow existing businesses. Perform this function by acting an intermediary between the individual wish to invest cash surplus and the companies to meet their deficit by raising new capital through the issuance of securities. Securities are of two types. One is the capital equity securities that include shares, and other one is the capital debt securities that include the bonds, or you can say different type of the borrowings. Thereafter, secondary markets provide an efficient mechanism for trading outstanding means already issued securities like shares or the bonds are translating the value creation or value destroying decisions of the firm into increase or decrease in the shareholders' wealth via high or the low security price. If there is a good information passed to the shareholders regarding companies, it will definitely increase the share price in the market. And in this way, the uh, the uh, the shareholders having the value creation by having the increase in their wealth. If there is a negative information comes in the market about the company, definitely it will decrease the share price of the holder, and they will destroy their share values or decrease in their wealth. These two functions are not independent of each other. The price of the securities in the secondary market is determined by demand and supply principle carried out by the trader in the market. Other phenomena is if a share is demanding its price well, increases, and if the supply is on the higher side, the price of the share might be decreasing. The price observed in the secondary market is then used by the investment or the merchants like bankers as benchmark. Here we have a diagram for the explanation of the same concept, the financial market that is divided in two parts. One is the primary markets and another is the secondary markets by their function. The firm receive the cash from the investors and issue them the new securities as a part of primary market. On the other side, investors receive the cash from the investors, and the other investor who receive the cash will transfer the outstanding or the issued security to the investor against the cash. So it's the phenomena of the both market. The equity market, here we have a concept of the efficient equity market. Share prices adjust instantly to the news and the relevant information. If the news is good, definitely the price of the share will increase in the market. If the news is bad, definitely the price of the share will decrease in the market. We have the example that if a company is going to bring new technology, definitely this is considered to be a good news, and it will increase the prices of of the stocks in the market. If we have a news that the company having or charge against any type of the plenty, it's a negative news, and that will definitely having the negative impact of decrease in the prices of the stock. Evidence indicate that on average, most well-developed stock markets can be described as reasonably efficient equity market. The efficient equity market play a key role in the process of value creation as the company announces a business decision that the market participants interpret as having a positive net present value, the company's market value should rise positively. Now, here one more question arises. Either the information is available to the all stakeholders or not. In developed countries, usually the information used to be available for all stakeholders, whereas in case of the underdeveloped and the developing economies, there are chances that the information might be available to few stakeholders and they can get maximum benefit from the information. Shareholders who wish to cash in do not have to wait for the firm to carry out its business decision. All they must do is sell their shares to immediately receive their part of the value creation by the firm's positive announcement. Now it depends on the stakeholders or the shareholders who wish to take the value creation benefit immediately or have to wait for other information to come, or they feel that their present investment having the more profit gaining opportunities, whatever the stakeholder is thinking, he or she will take the decision accordingly. Are the equity market efficient processor of information? Before answering the above question, we must think, do they provide an efficient mechanism to determine the reliable stock prices? Evidence indicate that on average, most well-developed stock market around the world can describe as sufficient efficient to be relied on to provide unbiased estimate of the share prices. One can't say the equity market are always efficient. We have the example of the stock crash when the stock prices were significantly moved away from their true value. It's very important to judge that the increase in the prices is either the bubble or not. In order to assess, you usually the intelligent investors also analyze the market prices to book price analysis. If the market price is far away or moving away from its book value, it means the market is creating a bubble, or there are the chances of the crashing. We have the example of such market crashes as well. How profitability is a firm, how profitable is a firm? Information provided in a firm's balance sheet and income statement can be combined to evaluate its financial performance. In particular, profitability of its equity capital and the profitability of the invested capital. Equity capital is purely owner's capital. Invested capital includes the part of equity capital and of debt capital. So you will have to evaluate the return on equity and return on total capital employed within the business. It is also important to evaluate the operating cash flow. There are cases the firm having the healthy financial position reflecting in balance sheet and the income statement, but operating cash flow responding adversely. So we have such example. An analyst or the investor should not purely rely on the balance sheet or the income statement, but also have to review the cash flow statement, and particularly operating cash flows. There are chances the company's balance sheet and particularly the investments are showing the positive profitability, but the operating cash flows may responding negatively. It means there are many or the few non-cash transactions that are not actually received of the cash, but they have simply accrued as a part of the income, or you can say particularly as a part of you, if you have accrued, you have your company have accrued unearned profit, so it might be something wrong as a part of your financial statement. Thank you very much. See you again with the upcoming video on the same topic very soon.